As of Thursday, December 25, 2025, the stock market is currently closed for the Christmas holiday. The most recent closing price for Plug Power Inc., trading under the ticker symbol PLUG on the Nasdaq, was $2.10 USD, which reflects a positive movement of 0.050 or 2.44% during the final trading session on Wednesday, December 24th. While a 2% gain might look like a quiet win to end the year, the underlying reality for this company is far more turbulent than that steady green number suggests. Most investors looking at their individual brokerage accounts see a stock that has been stuck in a brutal tug-of-war between high-level industrial promises and the cold, hard math of a balance sheet that has historically burned through cash faster than a liquid hydrogen rocket. But here is the insight most people are missing. Plug Power is no longer just a fuel cell company trying to sell forklifts. It has quietly transitioned into one of the world's largest logistics and infrastructure players in the hydrogen space, recently securing a contract with NASA that fundamentally changes the risk profile of its long-term debt. This is not about speculative green energy anymore. This is about the physical plumbing of a new global energy infrastructure that is being built right under our feet, while the retail crowd is distracted by the latest swings in Nvidia stock or Apple stock. The general market narrative around Plug Power has always been one of skepticism. If you scroll through any of the popular investing sites or check the sentiment on your Robinhood app, you will find a common belief that Plug is a perennial next year story. A company that promises profitability is just around the corner, but always finds a way to dilute shareholders before getting there. The reality, however, is starting to look quite different if you look at the institutional movement and recent trading volumes. While the retail crowd often uses Robinhood stock trading for quick hits, institutional players are looking at the massive 5-megawatt Gen Eco electrolyzer installation in Namibia and the Sunrise project in France as tangible proof of concept. The expectation is that Plug will continue to struggle with gross margins, which were historically deep in the negative. But the reality is that the company's Quantum Leap program has actually started to claw back some of those losses, aiming for margin neutrality by the end of this year. We are seeing a fundamental shift where the cost of producing green hydrogen is finally beginning to drop, thanks to the operational efficiency of plants in Georgia and Louisiana. When you look at the recent trading activity, the volume has been telling a story of consolidation. Throughout December, we've seen sessions where tens of millions of shares changed hands, often with the stock price remaining stubbornly range-bound between $1.90 and $2.30. This suggests that while some early investors are jumping ship, others are using their Fidelity brokerage accounts or Interactive Brokers trading platforms to build significant positions at these floor levels. The volatility remains high, with a beta of 1.74, meaning it moves significantly more than the broader S&P 500. This is exactly the kind of environment where self-investing becomes a test of conviction. If you're using SoFi Invest or a Fidelity mobile app to track your portfolio, you've likely noticed that Plug Power does not move in tandem with the big tech names like Tesla stock. It is entirely dependent on the macro-industrial shift toward decarbonization. Recent institutional reports indicate that while some major funds have reduced their holdings to manage risk, others like Vanguard have actually increased their stake, treating this as a long-term play on infrastructure rather than a short-term trade. The recent reaction to the third quarter earnings was a perfect example of the tension between expectation and reality. The market expected a disaster, but what it got was a revenue beat driven by a massive surge in electrolyzer sales, which tripled compared to the previous year. This sent the stock up over 5% in after-hours trading initially, though it later settled as investors digested the $375 million convertible senior note offering. That offering is a double-edged sword. On one hand, it provides the necessary capital to fund operations without an immediate massive share dump. On the other hand, it adds to the long-term dilution concerns that have plagued the stock for a decade. If you are managing your own wealth through a SoFi active investing account or using the Interactive Brokers platform, you have to weigh that dilution against the fact that Plug now has over $300 million in additional debt capacity and a clear path to finishing their DOE-supported projects. The company is effectively buying time to prove that its hydrogen plants can run at the 90% plus uptime they saw in Georgia this past August. Let's take a step back and look at what this company actually does, because the business model has shifted significantly. For years, Plug was known for its GenDrive fuel cells, the units that power forklifts for companies like Amazon and Walmart. That business is still there and still growing, but the real future of the company lies in its electrolyzer and green hydrogen production segments. They are building an end-to-end ecosystem. They produce the hydrogen at their own plants, they build the cryogenic trailers to transport it, and they provide the fuel cells to use it. This is a massive undertaking that requires billions in capital. It's much more complex than the software-heavy models of companies you might find in Fidelity mutual funds or an Intelligent Portfolio. It's a brick-and-mortar energy play. In the past, Plug relied heavily on buying hydrogen from third parties and selling it to their customers at a loss just to keep the contracts alive. Now, with their own plants in Georgia, Tennessee, and Louisiana coming online, they are finally starting to produce their own fuel, which is the only way the math ever works for long-term profitability. Macroeconomic pressures have also been a major factor this year. Higher interest rates throughout the early part of the 2020s made it incredibly expensive for capital-intensive companies like Plug to grow. However, as we see a shift in the interest rate environment and a renewed focus on domestic energy security, the tailwinds are starting to shift. The passage of new energy legislation and tax credits specifically for green hydrogen production has provided a safety net that simply didn't exist 2 years ago. This is why you see so many people looking for investment help on how to position themselves for a green recovery. Whether you're using Schwab Intelligent Portfolios or doing your own research on investing sites, the question is no longer if hydrogen will be part of the energy mix, but which companies will survive the valley of death to become the dominant players. Comment below how many shares of Plug Power you currently hold, or if you are waiting for it to break back above the $5 mark before entering. Looking toward the future, the outlook for Plug Power depends on two major catalysts: the finalization of the Department of Energy loan and the successful expansion of their European and African projects. The Namibian project is a massive test case for whether hydrogen can work in emerging markets with high solar potential. If Plug can prove that they can install and maintain 5-megawatt systems in remote locations, the addressable market expands from just U.S. warehouses to global heavy industry. There is also the matter of the upcoming special meeting of stockholders in January 2026. This meeting will likely address the company's capital structure and could be a major turning point for investor sentiment. Those who invest online through their Interactive Brokers account or SoFi trading platform need to pay close attention to the voting results, as they will dictate how much more the company can leverage its current assets. The risks, of course, remain substantial. The company is still burning through capital, and although the burn rate has been reduced by nearly 50% year over year, the clock is ticking. If they cannot reach gross margin neutrality by the end of 2026, the market may finally lose patience. We also have to consider the competitive landscape. Companies like Ballard Power and Fuel Cell Energy are fighting for the same piece of the pie, and while Plug has the lead in total systems deployed, it also has the highest overhead. This is why a lot of conservative investors prefer Fidelity ETFs that spread the risk across the entire sector, rather than betting on a single ticker. But for the individual brokerage user who is looking for high alpha opportunities, the current price of $2.10 offers a risk-reward profile that is hard to ignore, provided they have the stomach for the volatility. The divergence between the market's expectation, which is essentially that Plug will eventually fail or be acquired at a discount, and the reality of their growing infrastructure is where the opportunity lies. They have 40 tons per day of liquid hydrogen production right now. They have 72,000 fuel cell systems in the field. They are a primary partner for NASA. These are the hallmarks of a company that is not just a concept. They are the hallmarks of a company that is being valued by the market as a failure while it is physically building the infrastructure of the next 50 years. If you are using the Robinhood app or SoFi Investing to look for the next big move, you have to look past the daily fluctuations and see the industrial scale of what is being built. In summary, Plug Power is currently sitting at a critical juncture. The closing price of $2.10 on December 24th reflects a cautious but positive end to the session, but the real story is in the massive reduction in cash burn and the shift towards self-produced hydrogen.